Hello everyone. I'm Divakar, founder of Smart Trade Circle. Welcome to the sixth step foundation seminar today. I have more than 10 years experience in stock market, and I've seen all kinds. You can say the uh, bull market, bear market, all kinds. So I've seen my ups and downs also. So after all this, I've come to know the learning process cannot be that hard way. And until unless you know and learn in the right way, you will not be able to be successful in the trading concepts. So today I'll try and share my knowledge with you in whatever way it's possible. And I hope at the end of the session, you will be able to learn and understand how the stock market works. Let me share the screen and take you through the presentation. Well, today I'll be talking about the six step stock market foundation. And these are the 6 points. We'll begin with the basics of stock market. And the second would be how to open a demat and trading account and what are the users of it and types of traders and investors, which is very, very important to know and which will give us what we are, and the introduction to technical and fundamental analysis, which is also very important to know before you take any trade. And then finally, common mistakes beginners make. Well, the common perspective is stock market is very risky, and that is because people make a lot of mistakes, a common mistake, and then they are not successful. So finally, at the end, the topic would be on the building your first trading plan. Well, basics of stock market. What's a stock market? It's a market where, instead of buying vegetable or fruits, companies are purchased and sold. Well, not in a, if you are not able to completely buy the company, you can at least buy the portion of the company. So that is called as a share. So buying a portion and then selling based on the performance of the company. That place is called stock market. The stock market is managed by stock exchanges. Like in India, we have BSE, Bombay Stock Exchange, and NSE, National Stock Exchange. Well, apart from that, you need to check the performance of the company. There'll be a lot of companies and decide which company you are interested in and then buy it. Well, to buy a share or sell a share, the most important thing is you need to have a demat or a trading account. So, what's a demat account? A demat account is nothing but when you purchase a share, and that is where you want to keep it. Whereas a trading account is where you buy and sell shares. So nowadays, actually, when you open account, more or less, it's a combined account which you get. But if you don't want to do a regular trading activity and become a long-term investor, then a demat account is more than enough. Well, before I go further, I just want you to answer me the learning process on stock market. Do you want it in the smart way or in the hard way? So I want you to type yes if you want to learn in a smart way, and no if you want to learn in a risky way. Please type yes on the comment box if you are interested in learning in a smart way, and if you are Interested in taking risk and learn in a hard way, please type no. Well, nice to see almost everyone is interested in learning in a smart way. That's true. So let's go to the next topic, which is types of investor. We need to understand where we stand and what kind of investor I can be. So let me give you the types of investors. The first one is who buys a share and keeps it for a very long time. So he'll be called as just a investor. So if he's interested in the performance of the company and not anything else, and if he's having confidence, what he will do is he'll just buy and keep it for many years. So he'll be not interested in day-to-day affairs, ups and downs of the market. So he'll be called as investors. And the next one would be trader. A trader is the one who buys and sell shares on the same day, which is known as intraday trading. The difference between or the concept between the intraday trader versus investor is the stock price generally doesn't go up or down in a straight line. It's a staggered movement, it goes up and down. So when a stock price, if you're seeing a price from 100 to goes to 150 in 1 year, it doesn't go 101, 102, 103 towards 150. It can go up to 120 first and come back to 110 and then go to 125, come back to 120 and then go to 130, 140 like that. So the investor will not be worried when the stock price goes to 100 to 120 and if it comes back to 110 because his view is for long term and is confident that the company will perform very well and gives him the returns. But he will be getting the percentage of returns on the 5 years or whatever period, which can be, say, for example, 15 or 20%. Now, at the same time, what trader, intraday trader will think is he wants to make use of all the movements. When the stock price from 100 rupees goes to 110, he will research and sell in that place and make 10 rupees profit first. And if the stock price comes back to 105, he'll buy again and sells it when it goes to 120. So each time when the stock price comes back, he will be rebuying so that in that moment of 100 to 150 rupees, he would be making much more than the investor. See, technically, this is possible, but there are definitely a lot of challenges when you're doing that. But that's the concept. I hope you have understood that between the difference between the investor and the trader. Now, when I said the trader, he'll be looking for trading in just 1 day. When I said the concept of the price movement from 100 to 110 or so, on everyday basis also, the stock will be moving some percentage wise. Let's say, for example, 1% 1 day. That means the stock price goes from 100 to 101. Now, what this intraday trader will do is he will be looking for catching that 1 rupee every day. Whereas the next one, swing trader, what he will do is he'll be not so much interested in focusing or scratching his head for so much of movements. So what he will do is he will buy and keep it for a couple of days or a couple of weeks. He'll not be interested like an investor to keep it for a very long term, like 1 year or 2 years. At the same time, he's not interested like intraday trader who executes his trades in just one day. So he's a swing trader and looks for medium risk. So his trade lasts between days to just a couple of weeks. Now, the last one is again a very risky person, scalper. He is much more riskier in terms of compared to intraday trader. He buys and sells the stock in just minutes. In the 1% per day movement, which I was talking about, that doesn't mean that the stock price will move at the open of the market, say at 9:15, and keep on moving every hour by 10 paise, 20 paise until close at 3:30 and reach 1 rupee. It will happen in just a half hour or 1 hour. So what this scalper will target is he will research in such a way he will know at what time the stock moves. So between 9 and 9 to 10, suppose the stock is moving that 1%, he will try to catch that and focus on a different stock which is making its move at around 11 o'clock or 12 o'clock. So these are the four types of traders. Now I want to know from you, where do you stand? What kind of a trader you would be when you compare yourself to these four types of investors? Are you an investor, or are you a trader? Are you a swing trader, or are you a scalper? So please write it in the comment. Well, again, I'm seeing a positive moment here. That people are more interested in investing than taking risk like a scalper. Well, I'll come to the details in some other time, the advantages and disadvantages. For today, it's definitely good enough to understand and place yourself in the character of these one of these four. So let's go to the next topic, which is a very important part, technical and fundamental analysis. This is where most of the things are, you can say, two eyes of a stock market trader. Well, if one is fundamental analysis, the other one is technical analysis. These two are very important. So, if you are going to the stock market and plan to buy some stock, the first question comes is what to buy, right? There are hundreds of companies. So, which stock you should buy? And that is where the fundamental analysis come. That will help you look at the performance of each company through balance sheet, like looking at the profit and loss account, how much the company is making each year, whether they are growing year on year, and what's the dividend, kind of a dividend yeah, they're giving. Are they giving less or more? You can compare from company to company, and what is their consistency. So all these come under fundamental analysis. Based on this, you can pick up your favorite company to buy. Now, let's suppose you are finalized on company X, but just because you are finalized doesn't mean that you should buy immediately. There is a time factor. As I said, the stock doesn't price doesn't move on a straight line. If you're buying at the time when the stock price is started just going down, then the timing would be wrong. So technical analysis help you in understanding when to buy and sell the stock. So this consists of a chart where it's like a graph. The prices are marked through the help of a pattern like candles, and that is where when you understand and study, you'll come to know whether the price of the stock is growing or falling, and based on that, you can decide the time of buying. Now, let's go to the next topic like common mistakes a beginner make. So, after all this, if a person just go and buy a stock without any plan, and he's taking utmost highest risk, so a lot of people get encouraged looking at the news that stock market is making waves. It's growing. A lot of companies are making profits, and all of a sudden he's interested. Okay, let me also invest and make some big money. And with that enthusiasm, what he will do is he will not make any plan, research, which I was just explaining, and he will blindly go and maybe based on some tips from newspaper or television, he will blindly try to buy something. So that is absolutely not good. And the second one is when you are buying a stock and not keeping that risk portion, which is called as stop loss. You are buying a stock at 100 rupees. And as I said, the stock may on that particular day or particular week is underperforming and starts falling for some reason. So if you have to shift to another company, deciding that I'll be wasting my time if I'm depending on this stock to make money. So you need to have a prefixed stop loss. You need to have, say, for example, 2 rupees as your stop loss. You buy at 100, and if the price doesn't go to 101, 102, and instead it comes down to 99, 98, so you should exit at 98. But if there is a person who doesn't do that and believe, oh, this company is good, let me just keep it for a long time. It may go to 95, 90, sometimes 80 also. That gets you blocked your investment in that company. So you need to have a stop loss. And the next one would be over trading. I'm talking about intraday trading on this. People buy stocks in the morning and expecting on some news or something that this stock is going to go up on sure, and for some reason it will just do the opposite. For example, it's common on the quarterly results or annual results of any company like Infosys or Reliance. Based on the result, the stock on that particular day will go up in a big percentage. If the profits are good, surely the stock will also go up. So expecting this, a person may, in an enthusiasm, buy that company, but for some reason, the stock market rejects the company's performance will not be as good as expectation, and the price starts going down. So he will exit with a loss. Then what he will do is he will try to pick up another company, and it will happen the same thing, and he'll pick another company, and he will do over trading and end up in actually losing more money than making. So, over trading should be avoided. This is another common mistake we find on a beginner's method. Now, as already I was telling you about the newspaper tips or TV, even the SMS. See, if you are registering yourself on a broker and then open an account, you will be getting a lot of SMS tips. So it's not so good to depend on the SMS tip and buy unknown companies' stock. See here, my whole point in doing this smart trade circle community is I want people to do their own research and learn and execute their trades. In this way, you know, you are not depending on anybody, and you know what to do. You know the performance of the company by yourself, and you know the complete detail of the company. In that way, you have full control by yourself. And that's the best method. I'll promise you, those who learn by yourself and trade or invest, they are the ones who will make big money. And the last one is the emotion or revenge trading, which is also similar to word trading. So here, what they will do is people, you know, especially scalper trader, what they will do is they will every day have a habit of executing multiple trades like 5, 10, sometimes 20, 25 trades. So they will be executing something and the market will be doing the opposite. So they will end up in losing on almost every trade which they execute. So the more and more when they are trading, it becomes emotional, and it's kind of you want to revenge the market. You will say, let me see how much actually you're going to take away from me. All these things, all these kind of concepts will come to the mind and disturb them, and end up in making kind of a revenge trading, which is going to be a disaster. So these are the five common mistakes beginner make, and you should avoid doing this. Well, coming to the another important part is building your first trading plan. And I talked about the mistakes. Now this is about planning. So first is to decide what kind of a capital you can afford to begin with. So whether it's 50,000, 1 lakh or 10 lakh, based on your affordability in terms of comfort zone, you should bring in the capital. And just because you bring that X amount, say 1 lakh rupees, doesn't mean that you should go all out and start buying uh, the stocks. So you need to put the risk factor into consideration. The most important is, suppose you keep 10% as your risk. So if you decide, I'm not going to lose more than 10,000 rupees from my 1 lakh capital, no matter what, whether it's in 1 month or so. If I'm losing more than 10,000, I'm going to say goodbye to stock market and go. So if you have that kind of a actually strict discipline decision and fix your risk, uh, definitely it will work better, because saving a capital is the most important thing we feel is the thing one should look at. Next one is strategy. Now that we have fixed the risk factor to 10,000, now we can plan in how many trades or in how many days we can actually divide and buy how many number of companies. So there is a method and formula for that. It requires a little more time. So I'm just telling you how it works. In detail, I'll not be able to discuss today, maybe some other time. And the next one is time. time is again when you are buying the particular stock. As I said, the market opens at 9:15 and closes at 9:30. And the movement of the market or the enthusiasm in traders generally will be very high between the 9:15 and 10 because the market just opens. So that is the time you can see a lot of fluctuation in the price of a particular stock. So a scalper kind of a person would be interested in making use of that movement and make profit. Whereas a investor would be interested when the market is in a cool down mode and then buy the stock. So you need to uh, finalize that kind of a time what is suited for you to do the investment or trade. Now, review at the end of the day, you need to have a journal or a logbook where you need to write what went right and what went wrong that particular day. So it's very important to know and how a stock behaves because there are a lot of influencing factors. So if you start writing in a journal, at least a little bit, this will help in the long term. I never did this in the beginning. I have experienced more than 10 years. I never did in my beginning years. So I would just like, I did a lot of mistakes like any other beginner trade. I was just explaining you. So the learning process for me was extremely long. So if I'm going to share my knowledge today, I'm helping you guys in cutting down that long period which is required for anybody to learn the market. So you can let go the common mistakes which can happen and take the positive points and learn in a shorter period than it requires. Well, the six step foundation, the six steps I have discussed, and you know, I will be giving a free template for all the participants today. And in that actually there are a couple of informations which are useful for you to enter and understand. So you can fill that probably and put it on the comments on my later day.